How does the Black-Scholes model apply to options on futures? Have you ever wondered how traders value options on futures contracts? The Black-Scholes model plays a significant role in this process. Let's break it down to understand how it applies specifically to options on futures. First, let's clarify what options on futures are. These contracts give the holder the right, but not the obligation, to buy or sell a futures contract at a predetermined price before a set expiration date. Unlike options on stocks, options on futures are standardized and traded on exchanges, making them easier to manage. Now, the Black-Scholes model is a popular tool for pricing options. It was originally created for European options on stocks, but it can also be adapted for options on futures. This is where Black's model comes into play. Black's model is a variation of the Black-Scholes model tailored specifically for options on futures contracts. One key aspect of Black's model is that it simplifies the pricing process by treating the futures price as the underlying asset. This is important because futures contracts do not require an upfront payment for the underlying asset, unlike stocks. Therefore, when using Black's model, you focus on the futures price instead of the stock price. Next, volatility is a crucial factor in the model. You need to estimate the volatility of the futures price, which is typically done using historical data. The risk-free rate is also an important input. This rate helps discount future cash flows and reflects the opportunity cost of holding the option. The strike price and time to expiration are similar inputs to those used in options on stocks. These elements are essential for calculating the option's value accurately. In practice, traders use Black's model to value options on futures contracts, especially in markets like commodities and financial futures. For instance, if you are trading options on gold futures, you would consider the current futures price of gold, the strike price of your option, the time until expiration, the risk-free rate, and the volatility of gold futures to determine the option's value. Understanding how to apply the Black-Scholes model to options on futures can help you develop effective trading strategies. For example, you can use options to hedge against potential losses in your futures positions. Alternatively, you might buy options to speculate on expected price movements in the underlying futures contract. Another strategy is to create spreads by combining options on futures to profit from differences in volatility or price movements. By applying the Black-Scholes model, traders can better assess the value of options on futures and make informed decisions in their trading activities.